On Wednesday afternoon, you are sitting at your desk, calculator open, reviewing your spreadsheet. You've been doing the same calculation for 20 minutes. Your savings account has exceeded $47,000. Your total investment accounts are $23,000. Your total net worth outside of your home is $70,000. You are not rich, but something fundamental has changed. For the first time in your adult life, you realize that if your bank disappeared tomorrow, you'd be uncomfortable, but you wouldn't be devastated. That quiet realization that you are no longer tied to a single institution, that is the threshold, and most people never reach it because they're unaware it exists. My name is Logan Wolfe, and I've studied the exact turning point where people transition from being dependent on the bank to being independent of it. If you've ever felt trapped by your bank, thought you were doomed to pay inescapable fees, or wondered how much money you'd need to break free from the financial system's grip, subscribe, because what I am about to show you is the exact number that signifies power shifting from institutions to you. What most people don't understand about their banking relationships is this: you see yourself as a customer. The bank, however, sees you as inventory below a certain threshold. Serving you costs the bank more than the profit you generate. Above that threshold, you become valuable to the bank. But there is a third threshold that nobody talks about, the point where you need them less than they need you. In the 1970s, Americans would have a relationship with one bank for their entire lives. A checking account, a savings account, maybe a mortgage. Banks competed on trust and service. The average customer balance was $15,000 in today's money. Banks paid 5% interest on savings accounts. The relationship was symbiotic. So what about today? Checking accounts pay 0.01% interest. Big bank savings accounts pay 0.5% interest. High-yield online accounts pay 4 to 5% interest, but you have to abandon traditional banking to access them. Meanwhile, banks charge a $35 overdraft fee, a $12 monthly maintenance fee, and a $3.5 out of network ATM fee. We can say the relationship has been turned upside down. You pay them to keep your money. That is the mechanism that traps people. If your account balance is below $5,000, you are in the fee zone. One wrong move and you trigger overdraft fees. The likelihood of your balance dropping is probably high. More fees come in, you get stuck in a cycle where the bank profits from your financial vulnerability. If you are between $5,000 and $25,000, you are in the maintenance zone. If you are careful, you can avoid most fees, but you are still dependent on their infrastructure. An account gets frozen, a fraud alert pops up, a system error occurs, and you start to panic. When your liquid assets outside your main checking account exceed $50,000, something changes, not in their system, in your psychology. You realize you could move everything to another institution tomorrow and survive the transition. This option is the beginning of independence, but you are not yet fully independent. You are still using their payment infrastructure, credit cards, and credit products. The real threshold where dependence ends is not just about numbers. Numbers are part of it, but first and foremost, it is crucial that you manage your money psychology well and have financial literacy. On the path to financial freedom, most things depend entirely on your behavior and defense mechanisms. The rest is concrete numbers. This number averages $100,000. Let me explain why. When you invest $100,000 in diversified index funds or bonds, you will earn an annual return of $8,000 to $10,000 based on historical averages. This is sufficient to cover an emergency without touching the principal. If necessary, you can borrow money by pledging your portfolio as collateral at a rate of 4 to 6% through securities. Based loans, you no longer need the bank's high-interest personal loans or credit cards. This is the answer most people don't realize they're looking for. Once you reach a $100,000 investment separate from your checking account, banks cease to be a necessity and become optional service providers. You are no longer captive, you are shopping. And while shopping, you are in a position of advantage. Credit unions suddenly become attractive because switching costs don't scare you. Online banks may become attractive because you don't worry about physical branch access for emergencies. You've built up enough of a buffer to reverse the relationship. But let's dig deeper, because there are layers of independence that most people overlook. Financial independence from banks doesn't just mean having your money somewhere else. It means having your money in ways that banks cannot control, freeze, or use against you. Cash in a checking account can be frozen with a fraud alert. Investments in a brokerage account are harder to restrict without legal process. Physical assets like real estate create collateral that you control. Retirement accounts have legal protections that banks cannot touch. A truly bank, independent structure looks like this. A checking account holds at most 1 month's worth of expenses. Anything beyond that is a security vulnerability disguised as convenience. If you keep $15,000 in your checking account for a sense of security, you are essentially giving the bank a free loan. While this money yields no return, the bank lends it out at 8 to 12% interest. A high-yield savings account at a separate online bank holds your emergency fund, which should cover at least 6 months of expenses. This fund is liquid enough to be accessible within 48 hours, but separate enough not to be tempting to spend. The different institution creates a psychological friction that protects the fund. A taxable investment account holds your bridge money. This means that it is beneficial to be careful when evaluating your assets, because money has both a material and psychological effect on people. The material equivalent of this is an average threshold amount of $100,000. If necessary, diversified index funds that you can sell and access within 3 business days. This could be your freedom fund. Money makes banks optional. When this amount exceeds $100,000, you have probably reached the first level of independence. When you reach $200,000, you have almost reached complete independence. When you exceed $300,000, banks become insignificant outside of transaction tools. Retirement accounts in IRAs and 401ks can hold your long-term wealth. They have legal protections that checking accounts do not have. Creditors cannot easily access these accounts. Banks will not freeze these accounts without a court order. This is wealth outside the direct reach of the banking system. The more money you have here, the less influence traditional banks have over your financial life. Tangible assets, like real estate, businesses, or durable consumer goods, can create value streams that banks cannot interrupt. No bank permission is required for rental income. Business revenues can flow through payment processors that are not traditional banks. This is the highest level of independence, but it starts with reaching the first $100,000 in investable assets. This is precisely the issue that prevents people from crossing this threshold. Banks are designed to prevent this. Every fee, every low rate, every product that encourages spending over saving is friction that prevents you from accumulating assets that provide independence. They will constantly offer you comfort, increase your credit card limit. Returning to our topic beyond the examples I gave, the most significant factor affecting your first $10,000 in savings is overdraft fees. Low savings rates mean your money grows slower than inflation. Credit card offers encourage spending that consumes investment savings. The solution requires systematic behavior. First, you can eliminate all bank fees. If your current bank charges maintenance, overdraft, or ATM fees, you are paying a dependency tax after doing your own research. You can switch to a free credit union or online bank. Over 10 years, annual fees of $200 amount to a $3,000 investment loss. Second, establish your own system within the banking system. First, subtract your monthly expenses and then transfer the remaining money to investment vehicles of your choice. Speaking of investments, I would like to remind you that I do not provide investment advice on this channel. The first $10,000 is the hardest because you are fighting lifestyle inflation with no cushion. After $10,000, the next $10,000 will likely come faster if you avoid the mistakes I mentioned earlier, because you have a buffer that prevents fee increases. After $25,000, the acceleration begins because compound returns start making a meaningful contribution. After $50,000, you start accumulating wealth faster without even realizing it, because now you have the power of compound returns on your side. To do a simple calculation, let's assume you save $1,000 per month and earn an 8% return. You will most likely reach $10,000 in 9 months. In 22 months, you will reach $25,000. These are estimates, not exact figures. If you can set up such a system, you can reach $50,000 in 40 months. At the end of 69 months, you will reach the $100,000 threshold. If you are consistent, you can achieve independence from zero in less than 6 years. Investment behavior separates those who reach the threshold from those who remain dependent. Banks want cash in low, yield accounts. Independence requires transferring this to growth assets. The difference between saving 0.5% and investing 8% is the difference between dependence and freedom. Someone earning $75,000 and saving 20% saves $15,000 per year, with 0.5% savings. After 10 years, $154,000. With 8% investment, $217,000. This $63,000 difference is the cost of staying in the banking system. But you should also remember that when making an 8% return investment, you must be conscious and stay away from manipulation. Remember, there is no such thing as a free lunch. It would be beneficial to stay away from unknown and risky investments. As I said before, shape your own investment system. Once you can do these things, your financial psychology will change and mature. This transformation occurs when you have approximately $75,000 in investable assets. You start to think differently about banks. You stop tolerating fees. You compare alternatives. You realize you are not trapped. When you reach $100,000, the transformation is complete. You no longer ask, "Can I leave?" You ask, "Why am I still here?" Here is a comprehensive framework to accelerate your path to $100,000. Calculate your financial hostage score. Add all assets that banks can control or freeze, checking, savings, and CDs at traditional banks. If these exceed assets outside bank control, you are collateralized. Reverse this ratio, set clear thresholds. The amount in your checking account should never exceed 1 month's expenses. Amounts above this can be transferred to a high-yield savings account at a separate online bank. When savings exceed 6 months' expenses, additional amounts can be transferred to taxable investments. When the investment amount reaches $100,000, you achieve independence. Your paycheck is deposited into your checking account. Transfers are made the same day. An amount covering 6 months' expenses is transferred to the savings account. It is transferred to investments until it reaches $100,000. After that, putting the money to work before spending it is an important step on the path to financial freedom. You will understand the power of compound growth. Suppose you save $15,000 per year. After 5 years, the returns will be between $8,000 and $10,000 per year. After 10 years, the returns will be between $20,000 and $25,000. Your money works harder than you do. This is the passive income we described, which is what most people want. You may think that being dependent on the bank is a necessary choice until you find an alternative solution. When you keep $20,000 in a checking account that yields no returns each month, you choose dependency over independence when you avoid investing each month. Because you think the market is uncertain, you choose to remain under the bank's control. Today's financial system is designed to make dependency feel safe and independence feel risky. The data, however, shows that the opposite is true. The psychological shift occurs when you have approximately $75,000 in investable assets. You will begin to see differences in your relationship with banks. You stop tolerating fees. You start comparing alternatives. You realize you are not trapped. When you reach $100,000, the shift is complete. You no longer ask, "Can I leave this bank?" You ask, "Why am I still here when there is a better option?" Being completely independent from a bank looks like this: a zero-fee checking account at a credit union or online bank that covers 1 month's expenses. A high-yield savings account at an online bank that pays 4 to 5% interest and covers 6 months of expenses. A taxable investment account with $150,000 in diversified index funds that generates $12,000 in annual income. Retirement accounts with $200,000 that offer tax advantages. Real estate that provides rental income or home equity, accessible through HELOCs at lower rates than personal loans. Of course, these are not examples of investment advice. At this point, if your main bank were to disappear, you would hardly notice. If they tried to charge you fees, you would just laugh and walk away. If they offered you a product, instead of accepting it for convenience, you would evaluate the other 10 options. You are no longer dependent. You are a free agent, and this freedom accumulates like investment returns. The threshold that ends dependence on banks is not about becoming rich. It is about accumulating enough assets outside the control of banks to eliminate their influence over you. $100,000 in investable assets provides this for most people. Once you cross this threshold, every financial decision becomes a choice rather than a necessity. This is more valuable than the dollar amount implies. If this video showed you the specific threshold and path to bank independence, subscribe. I explain in detail systems for building wealth outside the control of traditional banking. Comment below on where you are on this path below $10,000, between $25,000 and $50,000. Have you surpassed $100,000? Let's compare what changes at each level. See you in the next video.